The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. If you're enjoying this podcast, we'd appreciate it if you would subscribe now to make sure you get them as they come out. And if the mood strikes, feel free to forward these to your friends, your family, your coworkers, and help us get the word out about this. Thank you.
And when it comes to investing, there are 2 days. There's the day when you say, I don't know why on earth I ever thought I should do this investment. And there's the days that are, man, if only I had bought this just a couple years or a couple days, a couple weeks ago.
Right.
I knew I should have done this, and I'm still sitting here in cash. What on earth am I supposed to do? It's the do I do or do I don't question, which happens to be every day in the market.
Right.
Most everybody who has done any investing for a reasonable period of time is familiar with Morningstar. Morningstar got their beginning I think in the early 80s. I don't think it was the late 70s. I think it was the early 80s. And they started with 2 publications. The first publication was on mutual funds. Mutual funds were the primary investment vehicle for the retail marketplace, and especially for 401k accounts, which in the early 80s had very limited use because it was not 100% tax deductible. It was 50% tax deductible. And I, being one of them, said, why would I make a deduction, and then tie my money up in investments for half of the deduction? So I didn't start an account until later on when the tax law changed. But be that as it may, Morningstar started out as its mutual fund publication. And you would get a pamphlet full of newsprint stapled together at the seam with pages of charts and data about recent performance on these various mutual funds. And it was load funds. Now, there were no load funds, but it was a bit later before Morningstar started publishing a no load subscription. So if you were a broker, you had to buy 2 subscriptions. Well, eventually that got merged together because in the beginning, investors in no load mutual funds didn't talk to brokers, and brokers didn't really want to talk to them if they weren't willing to pay commissions.
So those no load funds, they were never going to last anyway, right? There's no reason to talk to those no load people. That's just going to dry up and blow away. As we know, they did not only not to dry up and blow away. That's became the norm of the industry instead of just a side note, which is what the brokers were hoping for, because they don't get paid for no load funds the way they get paid. They got paid for load funds.
Well, in the whole transition to no load or low load first, and then to no load, was started by Charles Schwab back in 74, I believe, when commissions were deregulated by the New York Stock Exchange. And that just put on pressure for who can gather assets. The one with the most assets wins, because it's the lowest fee. I mean, and as an investor, you basically have been benefiting from this. As cost of being an investor has continuously dropped now for 50 years. And it's for the Wall Street firms. It's the race to the bottom.
Correct.
I can beat your fee, and if I can beat your fee, I can get your assets. Well, that's the game that's going on, and that's a benefit. But what's all this have to do with Morningstar? Well, one of the analyst at Morningstar was John Reckenthaler. And he's been a consistent commentator over time. And the issue for him has always been, at least as I interpreted his writing, was buy and hold. You just figure out what you're going to buy, and then you take your position and you hang on to it. And of
Forget
course, if
about it.
you
Yeah.
started with no load funds and you paid an 8.5% sales charge, you were doing a buy and hold, because that was an expensive transaction. So there
You
was
bet.
no real incentive to do short-term trades. But it's interesting, and only because he's retired recently. And most of the time, when people retire from a long-term career, their exit usually involves a recitation of personal accolades. And John didn't do that. John took a look at what he's learned as a commentator and an analyst at Morningstar and basically said, "This is what I've learned about investing." And that is, you take it seriously and you just simply need to be invested, because in the long run, there is no wrong time to get started.
And that is one of the hardest things for investors to believe. Most investors spend their entire investing life worried about the move they missed. Oh, we missed it. We should have been there. Like you said at the start there, Don, I wish I'd done this 5 years ago. Heck, I wish I'd invested 100 years ago, but I wasn't around then. So, but it's this perpetual belief that you've missed the boat and you're never going to catch up. And it's just not true. That's just not the case. You always know, especially in the U.S. market, there's going to be another bull market. It's going to continue. There's going to be winners, even in a bear market. There's going to be things that are going up, and to just miss the whole thing out of fear, that's mostly what it is. They always say the two biggest market movers are fear and greed, and boy, the fear is a really tough one. Um, It'll scare you right out of the market. And almost any day, you can list 10 reasons why no one should be investing in this market every day. No matter what's going on, no matter how good it is, there's a long list of problems that will potentially derail everything you've been trying to do. Most of the time, none of those things actually happen. You're worried about things that are not at our doorstep. And regardless of who's the fearmonger telling you, you better be careful, everything's about to collapse, it's rarely the truth. And it's a big mistake to believe that, now it's way too expensive, I can't get in, or there's too many bad things going on, I shouldn't be invested. It may mean you need to be more careful. That may mean you need to be more careful about where you're invested, but it doesn't mean you should walk away from the game ever. And the more you look at investing over time, the more you see that really is the case.
Well, and the part of that fear is markets are too high. In this case, particularly as we come close to the end of 24, we're now going to have 2 years back to back of really strong returns, at least as far as the indexes are concerned. I mean, there's a lot of stuff that hasn't worked, but the broader market has been healthy, even if it isn't all up in the 20% range.
Right.
They are generally above average returns available in multiple places in the marketplace. And so with 2 good years back to back, the fear is, well, this can't go on. There's no way that can happen.
Right. Right.
But in fact, the odds are, once you have good years, the odds are that you're going to have another good year. Good trades beget good trades. We still have the majority of retail investors sitting on the sidelines. And at some point in time, these returns are going to be big enough that fear of missing out is going to catch up, and FOMO takes over. Fear of missing out is a phenomenal driver. That's the greed driver. And we
Yep.
actually already see that as far as Bitcoin is concerned, going or starting particularly with Donald Trump's election, being a proponent of digital currencies,
Sure.
that has just excited the entire arena. But the other issue is that I, I invest at the top of a market and then it collapses. One of my long-term clients is a retired physician, and whenever I talk to him, he says, "The reason I hire you is because every time I buy something, it goes down." Yeah, I have a great track record, and it's always the wrong way.
Right?
He said, it's not my gig. Well, that is a risk. And so the people who jumped into the tech bubble back in late 99 had to suffer through the decline in 2001 and 2002, and it didn't bottom until March of '03. I mean, it was
Yep.
painful to watch losses that were 50 to 80, sometimes 90%, and a few bankruptcies. Those are frustrating. But one of the things that Ben Carlson did out of wealth of common sense is he went over and he dug out some charts from Ritholtz, which basically show that there is still a benefit for investors who are serious about it. We're not talking about traders who are trying to make money and get rich overnight. In fact, that's a very dangerous proposition for most
Sure.
investors. But if,
Sure
if
is.
you look at this chart, what you see is that even if you had invested, now this chart was basically calculated by looking at the January 1 of the year in which the market fell apart and what happened afterwards. And that the average annualized returns through October of this year for an investor at the peak of 29 was still almost 10% a year. Now, you had to suffer through some tough times, and of course, you
But
had to be very long lived, which is probably more than
right.
most people. Warren Buffett being an exception.
He would have made it. Yeah.
After 1940, after the great inflation problems of the 70s, the Black Monday of 1987, I remember that day very, very specifically. We were watching TV. We had to turn on the TV. We heard about the news and we turned on the TV. We just watched the market go tumbling down. And that was 3 months. It was 3 months. That's what that was. Three short months, and the market bottomed out on December 3rd, I believe, of 1987. But investors, even some of Wall Street, didn't believe it was over for 2 years.
Yep.
Disbelief holds you out of the market. And yet we look at each of these other periods of peaks, and the returns continue to improve for those who were faithful and believed that the US market actually has economics and has survivability. That's an important lesson, and that's the point of this podcast. Is we are sitting here at new highs. We've had 46 all-time highs in the S&P this year, and you
2024. Yeah.
and you say, how can that be? I mean, it can't keep on going. But when you look at fundamentals and you look at technicals, there is a lot of reason to still be in this market going forward. Not irrationally, but systematically with discipline.
That's the
Go ahead.
key. You never allow your opinion to override the data. When you're looking at the market and you're saying, well, this thing has been going up and it just keeps going up. And in fact, it's still making strong moves up. Don't pull the plug on that because you don't feel like it could keep going or you feel like it's gone on too long already. It doesn't matter what it feels like. The market's going to do what the market's going to do regardless of how you feel about it. And so that's why you need to have that process. Keep your emotions off the table, follow the data, follow the money, and watch it. Wait and see what happens, and don't leave the party early because you think it's starting to get late. You don't know what late is. You don't know what high is in a market that keeps climbing, and new market highs tend to produce more new market highs. So ride those. It's a good time. It's not a time to start worrying about is this happening too fast, or is it not happening in a broad enough market? There's still 100 things you can worry about if you want to. Look at the bottom line. Are we making money here? And if we are, it's a good time to be invested.
So if you're uncertain about how much money to put in, the way to deal with that is to basically dollar cost average. Even if you buy something and we get into a short-term correction and it's dropping, don't panic. If you made a, a disciplined decision and you don't own junk, you're not chasing some sort of junk stock, then just simply maybe add an extra $100 or $200 every payday. Add $500 a month or $500 a quarter or 1,000, depending on what your budget is. but
Sure.
work your way back into it. If it is dropping, we're in an economy that is not collapsing. At least there's certainly no signs of that at the present time. We still have good employment. Wages are still going up. They're not going up as fast as inflation, but the assumption is that a new administration is going to be able to get a grips on that, turn things around, and it will be doing better. But be disciplined about it. Don't panic. Understand what you're doing. If you need to, get some help. That's why we're here. We have a company that helps clients who want to be in the market but don't want to be bothered with managing the portfolio risk. So if you're interested in that, the contact information is coming up here. Subscribe to our podcast. You can always give us a call. If you found this of interest, you probably have some friends who have common interests like you do. We'd appreciate you sharing this with them, your family, and your work colleagues, if assuming that you're still at work. But pass it around. We appreciate that. If you want to sign up for our uh, month in review, basically the stock market, the first Saturday of the month, go to our website. Information's on the closing screen. We look forward to seeing you there. Have a good week.